I have some questions, but I hope that you do too. And I think it would be good to start with you if you have questions or comments that you would like to put to Brett. There's a gentleman right there. Fadi.
Thank you.
So Izzy's bringing you a microphone. So,
hello. Morning. Hey. Thank you very much for an enlightening speech. We talked a lot about technology and its usages. You didn't talk a lot about cybersecurity.
Right.
Identity theft, hacking, all of this, because the risks involved are extremely high, and until now we haven't seen enough work done in that field. Can you enlighten us a little bit? Thank you.
Well, I did and I didn't. So I talked about KYC shifting to data, because the data we traditionally use to identify a customer, like their passport or driver's license or their national ID, this information is no longer secure. So the data you would put on an application form is simply no longer enough to secure an identity. So you must use additional data. And so a passport will never really be secure ever again, because those data points that we use, are readily available through various means. And so the first thing you have to do is say, what additional data could we have that makes sure we know who you are? And so biometrics is key. Facial recognition, voice recognition, fingerprint, those types of technologies. But more importantly, heuristics are very critical. So heuristics is behavioral data. So now with fraud, for example, when we're looking at card fraud, heuristics is a major indicator of fraud. So, if you're opening an account in Qatar and you're doing it digitally, as an example, you can capture all of the same information you'd have on a application form. But someone could walk into a Qatari branch with a fake ID they've bought off the dark web in China and pass a physical ID verification in a bank branch. But online, if they provide that same data, we can do an IP check on the device they're using, and we can find that they say they're in Qatar using a Qatari address, but actually they're in Kiev in Eastern Europe, and that's where the IP address of the browser that's being used to open the bank account is, and we can deny that account opening application based on a data point you could never get in a bank branch. Now, in addition, those biometric data and all of that stuff that's critical to ID infrastructure in the future, we'll have to secure that in a way to stop it from hacking and cyber theft. And so we'll be using quantum computers for that technology. Particularly, we call it polymorphic encryption. It's an encryption technology built with a quantum-based private key built in. And this is essentially, it would take more processing cycles than all of the computers in the world could do over 10,000 years to break that encryption technology. And so it's the combination of those two ecosystems. One is creating identity infrastructure based on more robust data, and secondly, using quantum encryption to secure digital. So that's ultimately the answer. But thank you for the question. But we can't go back to paper application forms regardless. Just not enough data.
Gentleman there, and then there's another gentleman behind. Please.
Thank you very much for this.
Okay, we'll come to you next.
Oh, sorry, I didn't. Okay.
That's all right.
You don't need me here, Brett. I mean,
no, that's fine. No, go ahead.
No, I've been.
You started, please, sir. Go ahead.
Okay, I'd like to hear from you about your view about digital currencies and the use of blockchain to replace banks, as some predict.
I would suggest you read my book. It's all in there. No, just joking. So I had to do a plug for the book at some stage.
All we are is booksellers at this conference.
So ultimately, if you look again at the first principles design thinking, that if you were designing money for the world today from scratch, would it be geographically bound? There's a fairly strong argument that commerce is global today, that we need more global commerce enablers. And so from a value exchange mechanism, you'd probably build a digital currency that was unbounded by geographical regulations. Hence, we have Bitcoin and Ethereum and maybe the Chinese RMB, although they're going to try and make it geographically bound. Libra with Facebook. These are attempts to create value exchange mechanisms that fit more naturally with a digital ecosystem. And so we are going to see increasing attempts to create digital currencies. We will see the EU, China, and the US try and create their own competing digital fiat currencies at some point in the medium term, but we will have cryptocurrencies that compete side by side with fiat currencies in that digital space. Some of them will be focused on specific types of value exchange, tokenized for utility of certain applications. Others will be broader in their attempt. Bitcoin is probably not going to be a global digital currency of choice. Primarily, there's a design problem with Bitcoin that people like to hoard it because they think it's going to be worth millions of dollars in the future. And so it's more of a digital asset class today, digital gold, than it is a digital currency. But I don't think we've heard the last of cryptocurrencies. Now, the second part of that question is, does it get rid of central banks? Well, central banks as they exist today won't exist in the future, primarily because the regulation of money and banking will have to be much more global in its focus. When you start thinking about money laundering or anti-money laundering initiatives, for example, the best way to stop anti-money laundering is have a global alliance that looks at money flows around the planet, identifies suspicious actors by their behavior, and stops that money from flowing. Not doing a suspicious transaction report in a bank boardroom somewhere, and with a highlighter pen, the central banker going through a physical report to identify which of these transactions they're going to take further action on. It'll all be based on artificial intelligence. And so increasingly we see that global regulation will be done on a very cooperative basis across the globe. We're starting to see regulators enter relationships like that, being driven by the likes of Supendra Mohanty at MAS and Norman Chan in HKMA and others, the FCA in UK. But on a local basis, supervision will be more AI-based as well. So you won't have examiners going into each of the banks. It'll basically be the regulator's AI talking to the bank AI to determine compliance. That's how that'll work. Banks won't disappear as a result of cryptocurrencies, but we will have a lot of alternative value stores that do compete, that are unregulated, and it will be increasingly impossible to regulate them the way we have value stores in the traditional system. And so there will be a lot of value stores and faux banks sitting outside of the regulatory purview.
We're going to go to this gentleman here first, then we'll come to you, sir.
Thank you, Brett. It was a brilliant presentation. My name is Tufik. I just want to ask you about how can, within our region, put the regulator up to speed to enable innovation?
Yeah, look, I think here's the big problem that we have with regulation of the banking sector, to be honest. And I'm not picking on the regulators, right? Because some of my best friends are regulators, as they say. But the key point here is this, we shouldn't be looking to regulators to innovate. Regulators are probably the least innovative part of the system. They're there to protect from risk. Their goals are not to innovate. Having said that, the market must innovate, and so regulators have a role in letting the market innovate. So the most innovative regulators we see, like FCA in the UK and MAS in Singapore, HKMA, these regulators create these sandbox for sort of dynamic, innovative experimentation within a protected environment where the regulator can observe what's happening and can learn from those practical prototypes and experiments that are put into the market. And then if they work, they can sort of release that to the broader market. And so when we launched the bank account opening in the US without a wet signature, even though the regulations sort of let us do that from a regulatory perspective, the state regulator where we're regulated, they wanted us to only do 10,000 customers and then report back to them. And when we did that, they could see that we were secure, that our identity verification was working, that we weren't having huge amounts of fraud. So then they said, all right, we'll let you do 50,000 customers. And then it was 250,000 customers. And so it was sort of a progressive approach to the market. But we were very cooperative with them along that way. So What you see with the best regulators is they encourage fintechs to come into the market. They give fintechs licenses to operate. They create sandboxes so fintechs can come in to the market and play safely, and then allow them access to the broader market. In the United States, we see the opposite to this occurring right now. They don't have sandboxes at a market level. They don't have fintech licensing. So as a result, the US is now about 7 to 10 years behind China when it comes to innovation in the financial services space because of that lack of regulatory flexibility.
Fascinating. That's gentleman here. Izzy, thank you.
Hi, Brett.
Hey.
Great fan of yours. Follow you a lot on social media.
Thank you.
So, what's your take on Google getting into banking, and how does it affect, the neobanks, the challenger banks, because they can be very disruptive, and all the N26 and Monzos and Movens. What's your take on this?
Well, if you listen to the last part of my presentation, I talk about these experiences, right? Creating these banking experiences. So embedded in smart glasses, smartphones that respond to you as you walk in the grocery store, predicting mortgage needs and things like this. So this is a lot of AI and technology-based delivery. But the companies that own the operating systems, the voice-based operating systems, the smart glass operating systems, the smartphone operating systems, they can be gatekeepers for a lot of this technology. So it's fairly inevitable that the FANGs, the GAFAs, the BATXs will all be involved in financial services in some way, shape, or form in the future. Now, the Googles of the world don't necessarily want to own a bank with the regulatory requirements for owning a bank, but they may choose 2 or 3 bank partners that, for example, underwrite a checking account or credit facility that you can get accessible through your phone or through your smart glasses, for example. But they won't have relationships with every bank. It won't be like an app store where you can choose from every bank. And so I would encourage banks early in the process, particularly at a market level, to pursue those relationships with the Facebooks, the Googles, the Apples, because when they decide to come into your market here and offer financial services seamlessly or experientially through these operating systems, you want to be a partner of them because they will be disruptive. Doesn't mean that banks aren't going to be in the mix or fintechs won't be in the mix. I think that the ecosystem that evolves will have all of these companies playing. I will say there's definitely going to be less banks because there'll be consolidation. And we see this happening in the UK with the fintechs there taking market share. It's going to lead to consolidation in the market. So you'll have fintechs operating side by side with banks, and some fintechs will be these unicorns that specialize in one discipline, like TransferWise with cross-border. Others will be try to be a day-to-day banking relationship, like the fintech challenger banks. Others will partner exclusively with banks and embed their technology within banks. So it's going to be this hybrid architecture with tech giants, fintechs, and banks all working together. But the tech giants and the fintechs are definitely taking market share from the slower incumbents.
Thank you. We have one more question.
Last one.
Yeah, I mean, we could go on all morning.
No, I know.
Unfortunately, we need to talk about the future of banking, apparently.
Good morning. Thank you for the presentation. You spoke about first principle design engineering as a key, like we can call it the name of the game, to be competing in the new era of banking. Could you please tell us more about what kind of effort it requires to implement this principle within the companies in terms of culture? I guess it costs a lot. Is it the principle for the I mean, is it you need to be a very large company to do it? Is everyone able to apply these principles? Thank you.
Great question.
Yeah, good question.
Yeah, and actually gets to the real heart of the problem. SpaceX wasn't a large company when they took on NASA and Energia, the Russian rocket company, and yet they've been successful on a global stage with that. So I wouldn't say that being a large company is a prerequisite. But culture, you pointed to, absolutely. Culture is really critical. So in the 9th chapter of my book, I call it Adapt or Die, I talk about some of the things we see from the more innovative banks around the world. And one of the things I look for is I look at the board. Is the board got technologists on the board? Because, if you don't have a single technologist and your CEO started as a teller in the branch 35 years ago, then chances are you're not going to make it, Chances are you're just not going to be innovative enough because you don't have the right ideas being injected at the top down. Ant Financial, you look at their board, you look at their exco, every one of their team is a technologist. You look at the likes of HSBC, not a single technologist on the board, and their innovation department is separated from the main organization structure to the side. Now, that innovation department is growing, but whenever you have an innovation department that's responsible for all of your innovation, that tells me your culture is not right. You can't compete with a Alibaba, Alipay, and financial type structure. Now, I hope no one from HSBC is here reporting on this, but because I'm going to get into trouble. But anyway, but you get the idea.
Audited, Brett.
I might get audited again. So culture is really important. Siam Commercial Bank is really interesting in Thailand. I don't know if you guys have heard of them. But the CEO, he just became the chairman, actually, of Siam Commercial. He set the challenge for the bank about 12 months ago, and he said, listen, we are on this journey of transformation, and things are going to be changing very rapidly, and if you're not comfortable with that, we will help you find a job outside of Siam Commercial Bank. If you are comfortable with it, but you don't feel you've got the skills, we will retrain you, and we will make you a part of the future of Siam Commercial. But if you're not comfortable with this level of change, we will help you transition out of the organization, because we need a culture focused, on this shift. So I think that's sort of a more extreme example, but that's the type of thing that you need to really, as I say, get into this first principles thinking. Thank you for the question. It was great.
Yeah, good question. So, Brett, we need to finish. We need fewer banks. I have to get off the stage apparently, but. Where can we see more Brett? Book, podcast?
Yeah, I have a radio
more?
show called Breaking Banks, which is the #1 fintech podcast radio show in the world. Check that out. We interview all these fintech startups and disruptors and bank innovators as well as a part of this. You can read Bank 4.0, of course. You can get it wherever good books are sold, as they say. And tweet me out at Brett King, or friend me on LinkedIn and connect with me there.